Hello, hello, hello. How are you today?
Hey, good afternoon, Casey. Good afternoon, everybody. How are you doing?
Excellent. I'm really excited today for our conversation. It's been a long time coming, it seems, because I've been anticipating talking about credit because I know how important this conversation is to, I think, everybody. Everyone who I've mentioned it has been like, wow, that's a really valuable piece of information. And Ray, I know that you've been in the business for over 20 years and you are the founder of the McMillan Group and you are a real estate investor. So, can you tell us a little bit about yourself and what your relationship to credit is and what you're going to talk about for us today?
Sure. Yeah, I started out in the business back in the mid 90s. I got into mortgage brokering full time in 1999. It's a bit over 23 years. Um, like most people, I have a difficult time trying to navigate through the credit system. Being an immigrant, I didn't really understand credit scores and Equifax and all that stuff. So while my credit was fine in my earlier years in Canada, eventually it got a little messed up. And I had to learn to navigate through the process of repairing it. And then over the years, I've helped many of our clients do the same thing because many of them found themselves in the same position where they've either got too many credit cards or they've got challenges paying them on time once they find themselves in an overextended situation. So in today's conversation, I want to, let us tell our audience that even though you may find yourself with a bit of a credit challenge, it's not the end of the world.
And you said something unique when I was talking to you that you actually sit there and go through the credit with some of your clients so that they can either fix and repair their credit and address some of the delinquencies on their credit report. So, what do you do that for all of your clients? What does that look like, and when did you start offering that type of service?
Well, as a mortgage professional, you also have to consult with clients on their credit because that's one of the most important things when it comes to trying to get a mortgage. And most people don't know what their credit looks like or don't pay attention to it until they're ready to make a home buying decision. And they may assume it's okay, and sometimes it is, or they may assume it's okay and sometimes it's not. So when they come to us and we do the credit inquiry with their consent, we go through it line by line. And sometimes there are surprises. There's things that are there from several years ago. There are things that they didn't expect to be there. Sometimes they may have co-signed a loan for someone else. And while the person is paying that loan, it will affect their credit also in terms of what they will qualify for. And then sometimes it's just major delinquencies. Uh, so we work with the client to remedy those delinquencies. And there's no quick fix to that situation. You've got to really basically acknowledge your circumstances and then look at trying to remedy each item that's delinquent with the creditor, credit issuer, or the collection company.
Okay, so you mentioned a lot of key points that we're going to go back to here. You mentioned, addressing credit, your delinquencies with your creditor. You mentioned that most people don't know how to do this, so we're going to address all of those things. So if you're watching right now, this is a crash course into how to improve your credit. But before that, let's just generally talk about why credit is important in general. I know when you're buying a home, it is one of the criteria that you need? What kind of credit do you need in order to buy a home?
Ideally, you want to have a credit score that's above 700 with minimal outstanding debt. Um, you want to have trade lines that are 2 years or older. Minimum limit is between $2,000 and $2,500 with no delinquencies in the last 2 years. And that's basically it in a nutshell. And once you find yourself in that category, then most likely, you should be able with the necessary income and down payment to qualify for the mortgage that fits your circumstances.
Okay, so you mentioned the down lines, I think, for 2 years. Explain that to us in layman's terms. Just having credit for more than 2 years, is
Well,
that
there's new credit, which is credit that has no real history. So you can get a credit card 2 months ago and your credit score is 800 or 850. There's no real way of determining whether that person is a good credit risk or a bad credit risk, if they've got one trade line or one credit facility that is 2 months old with 800 credit score.
Mm,
So if you've got somebody who's had a credit card for 5 years or 10 years, they've got two trade lines at $5,000 total. Their credit score is 700. That's a much better credit risk because there's a history involved. So everything here is based on history. So there's a timeline. You know, like many of us will have gotten a credit card in high school. You get into grade 12, grade 13, you get your credit card. That's the most important credit card you're going to have in your life. That $500 credit card from one of the major banks. Because you fast forward 20 years, that credit card has history. It's been in your profile for an extended period of time. Most folks, unfortunately, either close that card or it goes delinquent, right? So that now your credit history will start from the next time you get a credit card. So the time has been reported to Equifax or TransUnion or Experian for those folks who are in the US is what is important when assessing good or bad credit, or
I
one of the factors that when it comes to assessing good or bad credit.
I definitely was one of those people who got the MBNA credit card in university. And I think the interest rate was like, I don't know, it was like, I feel like it was like 30% or something like that. And definitely took me a while to pay that one off because I didn't know, I didn't know anything about credit at that time. And I definitely maxed out that card and struggled to pay it off in university. So it's interesting that you're saying that that's a good thing to maintain, even though that the credit, even though the interest rate was so high. Do you still think that I should have kept that credit card?
Yes, I mean, ideally, your credit card in an ideal world shouldn't have a balance outstanding. So the interest rate shouldn't really be that relevant if you use your credit properly. The ideal situation is to use that credit card and pay it off within the billing cycle. So, even if the rate is 8% or 12% or 18%, if you pay it off within the billing cycle, you're paying the balance in full, or you pay most of it off, then the interest rate becomes a bit of a non-issue. The sad reality is many people carry a credit balance. Many people are carrying a balance, all the time. They're running, $5, $10, $15,000 in a revolving facility all the time because they're basically financing their lifestyle off of a credit card. And that's where the problems usually arise. Those are the people who run into problems. And those are the ones that we try to help when they come to us. Because usually there usually is delinquency in those situations at some point.
So delinquency is a major factor when it comes to your credit score. What is delinquency, and how do we manage that?
Okay, so if you look at your credit report, everything is reported over time cycles. So you got 30 days, 60 days, 90 days, and then beyond 90 days. If you pay your credit facilities within the 30-day window, then your credit rating is usually rated as an R1 for credit cards and lines of credits, or I1 for installment loans. And then more recently, mortgages are also reported to the credit report. So your mortgage paid on time will be reported as M1. If you go beyond the 30-day cycle, which is what you usually see when your credit card statement comes and you pay it late, then you go into an R2 situation. As you go further along the spectrum of late payments, that number behind the letter goes higher. When it gets to a state of delinquency, is when it gets to when you miss several payments, usually more than 3 payments. And at that point, you get into what is called an I7 or an R7 rating. And then if it's written off by the credit issuer, you have an R9 rating, and that's probably the worst rating you can have in your credit profile. But along with the credit cards, there are also some things like cell phones and gym memberships and those contractual obligations which report to the credit report that really affect many people's credit. Because if you join the gym and you break that contract and you agree to pay them $30 a month for the next 12 months, and you break your contract midterm, let's say in month 4 or month 5, many times that gym or cell phone company will report that balance on your credit profile. So while it was not a monthly credit obligation, you broke the contract and they sent that to a collection company. And many of the times we see those in a lot of clients' credit credit profiles. They may have a perfect credit rating with their credit cards, but it's just collection item for $200. Or they rented an apartment at some point and they moved and left a utility bill behind. So those are the things that can affect your credit score also. So while you've paid your credit cards and your loans on time, you omitted to pay this small item, which can usually affect your credit score negatively.
Interesting. Okay. So if you have no idea, I suppose, or even if you check your credit score regularly, but you don't know how to find these delinquencies, where do we go about addressing these issues that we're having with our credit? Like, what tells us, and how do we understand the credit report is what I guess what I'm asking.
Well, when you get your credit report, there are two types. There's some that come with a score and some without the score. I recommend most people get the one with the score. And if your score is below 700 and declining, then you want to know why the score is declining. As you get close to 600 and below, then usually there's a problem. As you go through the report, then you will see the issues. If you've got late payments, you've got stuff that's in collections, and then you have to figure out, okay, how do I resolve these things? And there's no magical formula. You've got to basically approach the creditors and make an agreement to pay them. Or if you're in a very extreme situation, then you either file for personal bankruptcy or do a consumer proposal, which will allow you to get some relief from extensive debt. But let's assume you just need a very basic debt, a few $100s or a few $1,000s, nothing extenuating. You want to basically go back to the creditors and ask them for some sort of settlement. So let's assume you had a credit card with credit card company A. The credit card limit was $5,000. You got ill or you lost your job. You used up most of the credit facility, and then you couldn't afford to pay it back. The interest will continue to accrue all the time. The credit card company would eventually sell that debt to a collection company. And the collection company will now start to call you to make payment. Now, your $5,000 debt might now be $7,000 because you've got all this accrued interest. You can now speak to the credit card company and explain to them that you're prepared to pay this debt, but you ask them for a settlement. And usually you ask them for like 30 cents on the dollar. That's usually an acceptable number, between 30 to 20 cents on the dollar. So if you owe them $7,000, I will pay you $2,000, send you a check tomorrow. You send it to me in writing that you're going to accept my $2,000, and that debt is now paid in full. No, that's not going to change your credit score immediately. At that point, you want to contact Equifax and have them report that debt as paid in full. A lot of times clients will they'll pay the debt, but they never contact the credit reporting agency. And it's going to stay there for a few years. It's not just going to disappear tomorrow. However, it's paid. That's the important thing. You didn't just ignore it. So if you go to apply for credit, you can provide an explanation and you made an attempt to deal with the debt. You didn't just walk away from it. And that's what a lot of people don't do. So what we tell clients to do is let's start with the smallest debt first. And we do what is called a debt snowball. You deal with the first debt, you settle that one. And then you go on, you keep going on from there. Sometimes clients who are homeowners may be in a position to refinance their mortgage and basically pay off all the debt. They may not have enough equity in their home to pay off the entire amount, but at that point they can say, I'm going to do a mortgage refinance. I have access to $30,000 in the refinance. I owe you $60,000 or $70,000. Let's arrange a settlement. You give them your income expenses and your liability sheet. They know you have no access to more money. And in most cases, about 85% of those cases, they'll accept your settlement, providing you keep the agreement. And usually there's a date when they want that money by. So I'm going to pay it off by the 31st of April. And you have your lawyer send them all their payments. And at that point, back to zero. But the important thing at that point is to start to rebuild your credit. Most people mess their credit up, get gun shy. They get scared. They had a traumatic experience when they were in their 20s or their 30s. Their credit got significantly messed up, and then they never go back and try to get a credit card And sadly, you have to have a credit card to get most things done in this part of the world. There's a car loan, there's a mortgage, because that credit card will now report to the credit reporting agency, Equifax or TransUnion here in Canada, and Experian also in the US, and that will rebuild your credit score.
Right. So definitely, if you had bad experience with a credit card in the past, definitely go out and try again once you clear your debt, is what I'm hearing. Yep.
Yeah,
And
definitely. And I mean, if your credit score is low, you can also apply for a secured credit card. Most banks will offer them, and some credit card companies also offer them. That's where you put a deposit down, and they give you a credit card either up to the amount of your deposit or somewhere between the zero and that deposit amount.
does that rebuild your credit in the same way?
Yes, it does.
And that's just to show them, like, I've always thought that I actually never quite understood the point of that. It's like, here's my $500 and I'm going to put on your credit card just so that I can use your credit card to buy things with my $500. Right? Like, I never quite understood the point of that. But I hear what you're saying is you're telling them, look, I want to be able to build credit with you. So I'm going to put my own money on the line so that you know that I'm responsible with credit. Is that kind of the
That is correct, because remember, now the credit card that they're going to give you, they're going to report it to Equifax or TransUnion. So every month you make your payment on time, and that will rebuild your credit score. So if your credit score dropped around 580, and you start doing that, within a year, you see your credit score start increasing. And then what happens also, as your credit score increases, you may be able to qualify for an unsecured card at that point in time. So you may have a company who may send you a card, they may offer you a $5,000 credit limit that's now unsecured, and will help you to even get to that higher credit score much faster.
So let's go way, way, way back, because there's been a couple people in my life that I've spoken to, and they have a credit card, let's say, I don't know, $1,000, $2,000. And they're paying it regularly. Like, they're putting, every time they get a little bit of money, they put $100, $200 on it. And then they think, oh, I'm doing a great job because I always pay it back. But they have no idea about the statement date. Can you talk about why the statement date is important? I know you already mentioned it in terms of like hitting in terms of the reporting and what they look at, but I just want to stress it because I know people who have omitted the statement date and just paid back their credit card in chunks here and there and thought that was enough.
Yeah, but when you get your credit card statement, it will have a minimum payment on a specific due date.
Yeah.
And what happens a lot of times, the people pay their card, if you're paying it in large chunks of money, but you pay it within that billing cycle, that won't affect your credit score. But if you're paying it in large chunks when you feel like, and you go beyond the billing cycle, even though you're paying much more than the minimum payment required, you aren't paying it on time. You've gone beyond the card's billing cycle, right? So 24 to 30 day billing cycle. So even though you're paying it, the payment may be only be $25 that's required to at the time, but you're paying $400 instead. And you're telling yourself, well, I paid you $400. Like, what's your problem? But no, I need my $25 on the 25th of the month. That's what you have to really grasp. So you've got to make sure that you make your minimum payment at the time that is due. What I usually tell clients to avoid that is have your minimum payment go on auto billing. So if you've got a $2,000 credit card and the payment due every month is $30, you've got it's maxed out to the limit, then have that amount come out of your account every month on the due date or a few days before for the minimum, and then you pay whatever you want to pay. When you choose to pay over and above that, then your credit card will always be paid on time.
That's a great, great, great tip. Oh, I see Verna has a question. Are the college or high school students who are issued credit cards also earning? If not, why would banks be issuing credit cards to them? So it seems like, if students aren't making money, why are banks giving them credit cards to begin with?
Well, most students who were in grade 12 and grade 13 in the past, had part-time jobs. And the credit card always came in, the credit card companies always came to the high schools and university campuses and give out credit cards. I mean, that was their attempt at teaching you how to use credit without any formal training. So you're basically left to your own devices most of the time and figuring it out. Now, some people were very fortunate; they had parents who were able to advise them how to use the credit properly, and some people who didn't have that option usually messed it up.
I was one of those people.
You can always fix it. Time fixes everything.
Yeah. Thank you for that question, by the way. And if you have more questions, send them through. Okay, so thank you for that detailed explanation about credit scores and what's the best? We talked about monitoring the credit. What do we do now if we have bad credit?
You got to first is acknowledge it. Most people put their head in the sand and ignore it. It's not going to go away. First is to acknowledge it, and then what is the bad credit? I mean, there's lots of things that can affect your credit, and I can give you a few items. There's one is credit card payments that go delinquent. Two are gym memberships and cell phone contracts. And for men, the other thing that can really affect your credit is delinquent support payments, alimony payments. Those end up going to the Attorney General's office. The people who are in business, it can be arrears income taxes, where there's a judgment or a lien against you by the federal government because you owe arrears income taxes. So there are multiple of things that can affect your credit over and above the credit card and the personal loan and the mortgage. And then there's also the mortgage. I mean, you can have arrears in your mortgage. You can have a power sales situation. But the key is you've got to find a solution at some point. Now, your credit report purges itself after a few years. So 7 years after the delinquencies, if you do nothing and you sit there for 7 years, eventually those items will disappear off your credit report. They will fall off, except for the ones against the federal and provincial government. Those don't go anyplace. And then you have, I forgot to mention student loans. That's another one that's very common among many people. Student loan delinquencies, where you've got a student loan that's guaranteed either by the provincial or federal government for a period of time, and then the interest deferred payment expires. You aren't earning as much money as you think you should be earning if you have this university degree, and you can't afford to make the loan payments, and those usually go into delinquency. Those debts don't disappear. You usually have to pay those, and anybody who's in that situation, they'd have probably found themselves having their income tax refunds taken by the federal and provincial government to settle those debts. But yeah, the only thing is to basically acknowledge the debt and start to work with your creditors on a orderly payment. Or alternatively, you deal with a trustee and you look at doing a consumer proposal or filing personal bankruptcy. Those are extreme cases. But for the average person, the first step would be trying to work with your creditor and come to a payment solution. I mean, I've had clients who've owed credit cards several $1,000s, and they told them that, okay, based on my current income, I can afford to pay you $50 a month. That's going to take me 10 years to pay this credit card debt off. And the credit card company agrees. And what that does, the credit card is not reported as delinquent. So you maintain a decent credit rating. But if you miss one payment, you've reached your agreement. And most times they just basically go back and they send it to the credit report agency, and that's it. You got not paid in full.
And you mentioned something about the 7 years that it drops off. I know that's not the ideal situation, but there are some people who live by that 7 years, my credit will reset. You had mentioned to me in an earlier conversation that sometimes you might think that your credit's going to reset in 7 years, but you picked up the phone when a creditor called you and that time restarted because of that.
Yes. What happens sometimes, actually, not many times, is that your debt is being sold with a credit card company or the bank to a third-party collection company. And that company tried to find you. They did a skip trace. They tried to find you for 3 or 4 years, and then they couldn't find you. And then they sell the debt to some other collection company. And then that person starts their search for you. And in year 4, they find you. So you don't make contact with the credit. There's communication. That clock starts all over again. So that 7 year dropping off your credit profile, the 4 years that has passed already is no longer valid. Right? And that happens in many cases where they've actually made an attempt. Because there's what's called skip trace. They've got your the phone number, they've got your address, they sometimes have your employer, and they'll try their best to locate you. And once they find you, then the clock starts ticking. You've got to start that debt all over again.
So that's why it's definitely better to address it yourself and start working away, chipping at it in the snowball, like a snowball pattern that you mentioned, rather than just waiting for it to disappear, right?
Yes, I mean, if your intention is to do, I mean, you have a plan. Let's say you're a you're a young person, you plan to get engaged or married or start a family. At some point you will have to apply for something. I mean, even to apply for an apartment today in most of Canada, you have to have a very decent credit score because even the rental companies are not going to accept your application. So I mean, to wait 7 years for your credit to reset itself is basically putting your life on hold.
Yeah.
Any kind of credit activity for that entire 7 year period. Now, that may work for some people, but I think for most people here, that's not an option. And what happens also that everything you do will cost you more. If you go to get a car, for example, you have to buy a car from a specific type of car dealership. You have a very high interest rate. You may not get a car you want to drive. I know, so that's not favorable, in my opinion. I mean, you want to deal with it. And most collection companies, once you do have a conversation with them, they could be reasonable. Some of them are not, but most of them will be reasonable. But life happens.
Yeah. Yeah. Okay. No, this is all very good. It's a lot. If you have any questions, let us know. But my goal is for you to walk away feeling like I know how to fix my credit. And now I actually had a client recently ask. She's trying to buy a home, and she only got approved for like less than what she can afford in Toronto, and she was going to ask her dad to co-sign for her mortgage. Now, when you are trying to fix your credit, is it a good idea, or if you're trying to maintain your credit or trying to help somebody else with your credit, is it a good idea to co-sign for others, family or otherwise, friends perhaps?
Well, there's no yes or no answer to that question. I mean, it all depends on how close you are to the individual and how responsible that individual is. Because once you co-sign that debt, you are equally liable for it also. So whether you co-sign a car loan or a mortgage, you have equal responsibility. So if that person does not make their payments on time, it will also affect your credit rating. What is also important for the person who's co-signing to understand is that debt will now be included in their debt servicing. If they try to do something else for themselves, for their own family, then that additional mortgage payment or car loan payment will have to be factored in when they do an application. And it may reduce their access to credit for things that they need to do in their own personal life. So, I mean, we always want to help our family. We always want to help our close friends. Hopefully, you don't have too many family members who need that kind of help all the time. But that's a very personal decision. I mean, there are many in today's environment. I mean, many parents are co-signing mortgages for their children just because of the nature of the real estate market. There are many parents who co-signed car loans for their children also when they were younger because they were working part-time or they were still in school, either high school or university, and they couldn't get a loan on their own or they couldn't get a very good rate, right? Because if you got somebody who has an established credit profile with a very good credit score, 700 or above, who's been in the credit report for a while, and you've got a person who is now 17 years old with no credit, the 17-year-old is considered the higher risk. And the higher the risk you are to the lender, then the higher the rate they will charge you, which kind of defeats the purpose, but that's the way the lenders look at it, right?
And the risk is because you have less of credit history lending to you, we could lose our money, so we want to charge you higher to recoup from anything that we might lose. Yeah,
that is correct. Yeah. So the younger you are, there's no real we can't gauge how you've paid your debt in the past. There's no point of reference. So I will say, okay, I will lend you the money if you have your parent or an older relative co-sign for it also.
Mm-hmm.
And with
Mm-hmm.
a car loan, which is usually 4 or 5 years, that person is tied to that debt for the entire 4 or 5 year period.
Right. Yeah, like I've definitely known people who put just on like a phone bill or something, their children on their phone bill, and
Yeah.
and the children don't pay it, and they forget that they added that second line to their credit, and now it's turned delinquent, and it's a whole mess for their credit. So I feel like this happens pretty often, and we have to. What can we do in that case? Just teach our children to be responsible, or pay it for them, or just don't do it in the first place?
Um, you can teach your kids to be responsible, and if you have the means to help them fix it quickly, then you can. I mean, I've done that um, in the past for my kids, help them manage debt, deal with debt that they found themselves in. They were just immature at the time they got it. They didn't tell anyone when they ran into a problem. They didn't know how to use the cards properly or the cell phone properly, and they ran exorbitant bills. And you help them once. Once should be enough to teach them a lesson. If they
Yeah,
do it continuously, then it's no habit. So you have to be able to figure it out.
right. I actually once heard that adding someone, like adding your spouse to your credit card profile to help them improve their credit is something that is an option. What do you think of that particular move?
I don't particularly agree with that process.
Hmm.
Um, I would prefer each person to build their credit profile individually.
Hmm.
Um, because again, you have to know manage that person's credit spending habits and spending lifestyle. I mean, if they're not going to use the card frequently or use it only with your permission, then you're fine. But to put somebody, let's say you had access to a $10,000 gold card, and you put your fiance or your husband on the card, his his um, his ability to use credit uh, properly might not be the same as yours. So he may, use the card in a way that is not what you expect, and then you find yourself in a position where you overextend it very, very quickly.
Hmm.
And it's very easy to rack up debt if you got, poor spending habits, right? So I mean, I think it's important for everyone to build their credit profile individually.
Okay, that's good advice. That's good. Okay. We've covered a lot of the key points that I wanted to cover, which is really, really great. What if you own a home already? Let's say you already took the plunge, but you are running into credit issues now. How do you repair those issues and hang on to your home?
If you own a home and you've got equity in your home, then one of the ways to basically get rid of the debt is to do a mortgage refinance, where if you've got significant equity, you can refinance your mortgage up to 8% of the appraised value and pay off the debt. Now, if you own a home and the debt is already delinquent, and you found yourself, let's say through job loss, death of a spouse, or a marital breakdown, and you've got one spouse, usually the female spouse ends up in that situation many times where um, you know, they're left with the home. Um, Many times they're forced to deal with a trustee. And what they will do in some cases is that the trustee will negotiate that debt and settle it for pennies in the dollar, and through what is called a consumer proposal. It's not as extreme as a bankruptcy, but most institutional lenders view it sort of the same way, at least here in Canada. That proposal will usually damage your credit rating. It'll pull your credit score down. And it's usually paid over a period of 4 or 5 years. Now, what many clients don't know is that you can pay off that proposal 6 months after you've entered into it. So if you've got $100,000 of revolving debt that is stifling you, you go to a trustee, you settle that debt for probably $40,000, you enter into a consumer proposal, and it's registered as a credit repair facility, or a credit repair option, sorry, in your credit profile. You can now come to a mortgage professional 6 months, or let's say 4 or 5 months, and then start planning to pay it off in month 6. What that does, it helps you to rebuild your credit much faster. Once you've paid the proposal off, you can now go back and reapply for a secured credit card and start rebuilding your credit. So when your mortgage comes up for maturity, if you want to renegotiate it, you don't have that delinquent debt hanging over your head anymore. And that is something that a lot of homeowners need to know, because many times again, they put their head in the sand and they sort of ignore this debt.
That's very interesting, because it sounds like a good option when you have equity in your home and you can move that money. But what happens if, let's say, you don't own a home and you do have this debt? Let's say you have $40,000 worth of debt. In a situation like that, would you also recommend someone to do a consumer proposal or a bankruptcy, or would you say that that's an opportunity to take a look at your credit report and start working on these and start negotiating your credit on your own?
Well, it depends on what their income sources are. I mean, if you're in a position where you've lost your job, you're unemployed, I mean, your options will be very limited, and that it may mean you have to file a personal bankruptcy. But I mean, if you can do a settlement and negotiate payments that are reasonable, and you can afford to do that and still live reasonably well, not exorbitantly. I mean, you have to make the sacrifice when you find yourself in a position of delinquency. If you can do it, then I would recommend doing that, because the bankruptcy, that stays in your credit profile for a while. And if some lenders were involved in that bankruptcy, when you try to get a mortgage in the future, those lenders will not lend you any money again in the future. Most of the major banks will not deal with you if they were involved in the bankruptcy. So if you had 3 cards with 3 of the major banks in Canada and filed a personal bankruptcy, then your financing options in the future are going to be very, very limited, because none of those 3 banks are going to want to deal with you. And if they do, they might, offer a higher mortgage rate. They may reduce the amount of money they're prepared to lend to you. They may want a co-signer or a guarantor, and this becomes very, very challenging.
So if you have, let's say, ruined your relationship, I don't know if that's the right word, but with TD or Scotiabank or, some of the top banks in Canada, and you're getting a mortgage maybe through a mortgage broker, are the brokers like yourself going through major banks, or are they going through private lenders, or what does that look like and feel like if you're using a mortgage broker?
Most mortgage professionals would deal with the major banks. Some of the major banks, not all of them, deal with mortgage professionals. TD Bank does, so does Scotiabank. But there are also what is called monoline lenders, which are prime lenders who are not banks. So they don't have a bank branching network. And there are many of those lenders out there who will offer rates just as good or better than the major banks. And then there are what we call alternative lenders, who will deal with individuals who have a bruised credit profile, but they usually require larger down payments or more equity in the home. And usually that amount is 20% of the home value, or 20% down payment. Their rates are usually a bit higher. There are usually lender fees involved. But there are options. I mean, I always tell people, anyone can get a mortgage. It just depends what you want to pay for it. Right. So, I mean, the more delinquent the credit profile, the more bruised the credit profile, then your options will go in the other direction, from prime lender to alternative lender to private lender. Right. And the more you go down that continuum, the higher that interest rate will go, and the higher the fees will become. So you have to decide, okay, do I want to go that route, or do I want to take the 2 years or the 3 years and rebuild my credit profile? In today's real estate market, with prices going the way they are, many clients may decide, many potential buyers may decide to go the route where, let me go the private route, because I'm still going to be building equity if I buy today, as opposed to where in 3 years from now, the prices may be significantly higher, and it might be much more difficult for me to get into the home buying market, or to get a mortgage, right, if it's a refinance.
Absolutely. Okay. Well, I have to ask you about this, even though it's not necessarily a credit question. But for people who are, like you said, looking to get a mortgage now instead of, 3 years from now when prices might go up, or we don't know what's going to happen really with the market. I hear a lot from mortgage brokers just say, oh, you should get a mortgage now before interest rates go up. Or, or some people are waiting perhaps to see what the market does, to see what those interest rates look like. Would you say that it's the best time now to get in while you can still lock in lower rates, or what would you say the best way to navigate that is?
Well, there's no crystal ball when it comes to buying real estate. It all depends on your personal circumstances. My advice is very simple. If you have all the variables in place today to buy real estate, it means you've got the down payment, you've got the necessary income and employment, you've got a good credit profile. I mean, why not buy the home today? I mean, if you don't have all the variables in place, if there's a credit issue or there's an income issue or down payment, then you have no choice but to wait. But I mean, timing the real estate market is virtually impossible. I don't think anybody's ever done that properly. To time any market, whether it's the real estate or the stock market, is virtually impossible. I mean, we have no indication of what the federal governments will do with interest rates from time to time. I mean, the indication is that rates may go up over the course of the year, but they may stop at some point. So I think it would be if you have everything in place, then do it now. I always tell people the best time to buy real estate was yesterday. The next best time is today.
Oh, that's a good question. Thank you. What's the difference between a cosigner and a guarantor?
A guarantor, in terms of a mortgage application, a guarantor does not go on title, while a cosigner goes on title.
So that means that cosigner will own a part of that property.
Real estate, yeah.
Yes.
And the guarantor is on the debt, they're not on title. The cosigner goes on both. So I mean, I wouldn't guarantee anybody's mortgage. I want to go on title.
And so is a guarantor sort of like, so it affects their credit profile, but they don't own a piece of.
Yeah. So a guarantor would be someone like, okay, you've got your parents, you've got your young son. He just got married. He qualified for the mortgage on his own. His credit score is a bit not quite where it needs to be. There's no major delinquencies. He's just started his career. He's on the contract, but his income will increase in the future. The bank will say, yes, we do this deal with 10% down, but we want your parents to guarantee it because your parents also own a home, right? They have their own assets. So it brings strength to the application. So yeah, that transaction will be guaranteed. The guarantor is not entitled. Now, in the case where the person has delinquencies and credit issues, the lender will say, okay, we want a cosigner. And that cosigner is on the application, and they're also on the title of the property. I don't think many people guarantee mortgages for anyone today. There's not too many guarantors around. Most people go on as a cosigner. They cosign the debt. They're equally liable for the debt.
Okay. Thank you for that. Do we have any other questions? So I just want to nail this part home so that everybody walks away with this ingrained into their brain. And I know we mentioned at the very beginning of the conversation, but how do I qualify for a mortgage? Is the credit score that I need, and the amount of money that I need, and the credit score that I need and the amount of money that I need to qualify for a decent mortgage?
Well, this mortgage is relative to your circumstances, right? So your income will determine how much mortgage you qualify for. If you make $100,000 a year, then you'll qualify for about a $450,000 mortgage, right? So if you make $200,000 a year, then that amount goes up. It doubles, right? Your down payment is also important. If you only have $25,000, then the maximum purchase price you qualify for, based on our down payment guidelines in Canada, is a $500,000 mortgage. So everything sort of ties in together. So your income is important, and your available down payment is also important, and then the credit profile is important. I mean, in order to have your mortgage assured, if you put no less than 20% down, your credit score has to be 680 or higher for the default insurers to even look at the application. With a credit score below 680 and a down payment of less than 20%, you have a bit of a challenge. So that's why it's very important to get that credit score above 700, right? So you want to keep your limit, and that's a graphic that shows what good and bad credit scores look like, right? You want to keep your credit limits below 30% of the available credit. That helps to build your credit score. You want to pay your credit cards in time. You want to try to avoid dealing with finance companies and payday loans. Those things pull your credit score down. And you want to, keep those old credit cards, even though they only have a very small credit limit, because your length of time on the credit reporting agency is also very, very important in terms of building that strong credit profile.
Gems. That is it right there. That's the clip that we're gonna keep repeating to ourselves and keep top of mind, because that's what we really need to know. But you mentioned something about payday loans, and you know what? I know some people who bring themselves to the payday loan center to get that advance. Why is it that affects your credit?
Because the payday loan affects the credit if you don't pay it back on time. Then they report it. And what a payday loan shows is that the individual has very poor cash flow management skills. And this is probably because if you have to get a payday loan to wait for your next pay period or your next paycheck, whether it's weekly, monthly, or bi-weekly, then you may want to start with a financial advisor, look at some cash flow planning, because there's something wrong. Either you've got a very bad habit or you've got an addiction problem. And if you have neither of those two things, then it's probably just very, very poor money management.
Okay, fair enough. Fair enough. And I've been listening to Orlando, the financial advisor. That he does some really great seminars, some online seminars, and I've been thinking to myself, when is the right time to talk to a financial advisor? Like, if you feel like you're not at the place where you're not making $100,000, do you need a financial advisor?
The answer is you always need a financial advisor. I mean, as soon as you get out of high school and you start working, if your parents work with a financial advisor, then you want to have that conversation as soon as possible. The income is unimportant. What it is, that advisor brings structure to your financial life, and they will educate you on products and ways to invest and save money that you may not know, or it may take you a very long time to get there. And they teach you how to do it effectively and efficiently. There are certain investment vehicles that they will educate you on, tax savings vehicles. They will teach you about cash flow management. They will teach you how to invest regularly at regular intervals so as to avoid timing the market. So there's a whole lot of benefits that a financial advisor will bring to the equation. My career started off in financial advice. That's where I started out back in '94. And I held one of those roles with a major bank for quite a few years also, where I worked with a lot of high net worth individuals. But I also advised people whose incomes were very basic, where they invest $50 a month, $2 a pay period. As your income increases, your investment amount also increases. So that financial knowledge is better to start it sooner rather than later. The earlier you start, the happier you will be when you get into your 50s and 60s. The later you start, your timeline is now shortened.
Okay, that makes perfect sense. Because even I was listening to him, and I was like, well, maybe in a few years I'll get my financial advisor on, because I've had financial advisors in the past, but I was just thinking, like, they're just going to sell me mutual funds, and they want to sell me products, and I didn't actually see the value back then. But now I'm reassessing my relationship to my long-term view of money and wealth and credit and ownership, and now I can see how these go hand in hand. But I definitely had some wrong perceptions. I definitely held some perceptions about money that I think held me back for a long time. And luckily, there's a long way to go. And like you said, you could start anytime to rebuild your financial future. But thank you for that, because
You're
I'm going to
welcome.
call a
Many
financial.
of us have those challenges. The financial planning not only includes investment, it also includes protection. So you have your insurance products, whether it's life insurance and disability insurance and critical illness. So I think it's very important, particularly as young families and young parents, that we put those things in place because life happens. And you don't
Absolutely.
want them to have a GoFundMe to deal with the personal crisis. You want to be able to manage your family from your own resources.
Absolutely. Absolutely. Okay. Well, if you guys are like me, you've learned a lot today. Raymond, our conversations are indispensable because the wealth of knowledge that you have is out of this world. You are a resource of just incredible information, and I always enjoy talking to you. So thank you. Thank you for sharing your wisdom with us today about how to fix your credit and buy a home, and so many other things that we've covered today. Do you have, where can people find you? And I know that you're not necessarily working in the office. Your son is running the office, but how can they work with your son, and how can they talk to you if they want your advice or anything like that?
Well, we have an office in Mississauga, 6981 Mill Creek Drive. We've been here for the last 23 years. They can visit our website, mcmillangroupinc.com, or they can call us either toll free, 1-866-883-0885, or local, 905-813-4354. I also work out to the US on occasion. I've got a US number also, which is in Northeast Florida. It's 904-586-5636. But the office is always open. Somebody's always here. And we always welcome conversation. We don't, the doors are always open. And you're welcome to stop by anytime. If you want to make an appointment, that's fine. But if you just want to stop by the office and have a chat for 5-10 minutes for half an hour, we welcome that interaction with our clients and prospects.
Beautiful, beautiful, guys. You heard it here first. I am Casey Ann Bradfield, and I am a real estate agent with Keller Williams Legacies Realty. And I'm all about getting you into your first home or your second home, or helping you sell your home. But I think the key is making real estate affordable by having these types of conversations and empowering you to build wealth through real estate. So thank you so much for joining us. And I hope that you learned something. And follow me at affordable_ownership on Instagram, or just friend me on Facebook, Casey Bradfield. Thank you, guys.
Thank you very much.